Lots of talk about interest rates, and today I'll break down how mortgage interest rates are determined. All right, so there's four main criteria that go into determining your mortgage interest rate because everybody doesn't get the same rate. So when you see online, hey, the average interest rate is whatever, well, you're not average, are you? I hope not. You're not going to get the average rate probably because there are factors that go into it. There are four main factors, and I'm going to break down the fourth one because I think it's one that most people don't understand or don't realize. The first one is your credit score. I mean, that one I think a lot of people probably understand. Hey, if your credit score is higher, typically your interest rate is lower. It's a less risky loan to the bank, and you can improve your credit score, which can help your interest rate. Two is your down payment percentage. Once again, typically the more you put down, the lower your interest rate. It's a less risky loan for the bank. You may not have private mortgage insurance, PMI, if you put enough down. Sometimes you can not have it, but take a higher interest rate. So generally speaking, the more you can put down, you'll be able to lower your interest rate. And once again, you can save up over time and get to that next level where that would improve your mortgage rate. The third thing is the length of your mortgage. Not a lot of people play with this, but you can have a 15-year mortgage, a 30-year mortgage. The amortization length, that amortization means how long are you paying it out over. The longer it is, the lower the payment, right? I mean, if you're trying to pay it off in 15 years versus 30 years, it's going to have an impact on how long it takes you to pay it off, obviously, and it has an impact on your rate. You get a lower rate typically if you take a shorter amortization period because the bank gets their money back faster. The final one is the loan type. Now, I think this is the one that a lot of folks don't realize how many loan types there are. When I say loan type, it's like, hey, am I getting a fixed rate mortgage? Am I getting one where I'm paying principal and interest? What about all the lingo that you hear from 2-1 buy down or an ARM or discount points? What do those things even mean? Well, first and foremost, this is why you need a guide to help you evaluate your options because there's not one option that is right for every person. It depends on your situation. Let me break down two of those for you. One, which is a complete marketing gimmick, and the other one, which does make sense for a good amount of people. First one, that's a marketing gimmick. Y'all seen a lot of 2-1 buy downs? Wonder what that is? You see that term? That means in the first year, you have bought down your interest rate by 2 percentage points. So if your interest rate on this 30-year fixed mortgage is going to be 7 for the entire time, it's going to be 5 in the first year. You've bought down 2 points. In the next year, it's down 1 point. That would be 6. So you get 5 the first year, 6 the second year, 7 for the rest. Well, I mean, obviously awesome to have a lower interest rate at the beginning, but does this make sense? Well, the way that it actually works is you're just prepaying that. You are paying the interest you would have paid in those first 2 years are being paid up front. Even if the seller is paying this for you, wouldn't you rather just have the cash? I mean, have the seller pay closing costs for you so you have less cash into the deal? You basically have the option, could I have the money now? Or could I save it on my interest rate over the next 2 years? I mean, you tell me, would you rather have the money now or would you rather save it over the next 2 years? Almost everyone would pick now, right? Unless you think you're going to lose it. But a lot of people are like, hey, you need to get these 2-1 buy downs. It's really just a marketing gimmick. One that is not a marketing gimmick is an ARM, adjustable rate mortgage. Now, this doesn't make sense for everyone, but it might make sense for you. That means that the mortgage rate will adjust at some point. So I just mentioned, hey, you can have a 30-year fixed mortgage rate. That means your rate's constant the whole time. Well, in an adjustable rate mortgage, it's fixed for a certain amount of time, and then it can adjust. Well, who would this make sense for? Because, I mean, it could adjust up, it could adjust down. You don't want to be in a bad situation where it adjusts up. It could be where, hey, I know that I'm coming to Atlanta for grad school. I'm going to be here 4 years. There's no chance I'm keeping this as a rental property. Well, you do an adjustable rate mortgage where it's locked for 5, 7, 10 years. I mean, odds are really low that you're still going to have this property if and when it does adjust up. Another person it makes sense for is, hey, you could pay cash for the house, but you don't want to because you want to keep your cash just in case or for something else. Well, you take the adjustable rate mortgage. If the rate goes up in the future, you just pay it off if it's at a point where you don't want to. So there are situations where things like that, and this is just one of many, many options, can make sense for you. And there's situations where it's a complete marketing play. And that's why you need a guide to help you figure it out. We would love to guide you through it along with our trusted lender. So reach out. We'll help explain all this stuff to you and make sure that you are making the right decision.